A big day for the market, John. I'll start with you. How do you think Powell approaches this question around taper? Does he start by being non-committal, or do you think he'll be direct and say exactly when we could expect the Fed to move?
Seema, thanks for having me on this morning. We've got to think here that Jerome Powell is likely to give at least some tidbits of a hint as to what is forthcoming in terms of tapering. We don't think it'll be very specific. We think they're going to wait for the FOMC meeting for that. But we do believe that the market will be watching today and listening. And Jerome Powell knows that. The Fed is very sensitive to the status of the economy, both weaknesses and strength. We think they've managed this fairly well so far, and we think they will continue to. So all eyes and ears for Jackson Hole, 10 a.m. this morning.
Ryan, how do you expect Powell to approach this topic of the taper?
Yeah, I'm with John on this. I think that we may get some indication on the tapering, but also we still have this huge human infrastructure package that may get passed on Capitol Hill. So I suspect the Fed here is probably going to hold off on any real indications till we know how much stimulus is actually going to be pumped into the economy. So when we know the fiscal situation, I think we'll see more on the monetary situation. But at the end of the day, look, it's coming. Whether it's next month, whether it's the beginning of next year, at some point here, we're going to see tapering. We're going to see the Fed start to raise interest rates. And the bottom line is the economy is starting to rock. Once this Delta variant starts to subside a little bit and we see the reopening with schools back in September, and basically we start to see a lot of these unemployment benefits come off, a lot of people back in the workforce, the economy's going to run hot.
If the economy is running hot, John, where do you put your money to work? I mean, consumer prices have certainly been on the rise with the exception of last month.
Right now, we continue to like information technology, consumer discretionary, industrials, and financials. That gives us a barbell. Within those spaces, what we're looking is for growthier value and garpier growth. So it essentially growth at a reasonable price relative to where tech is on valuations. But you want to be cyclicals over defensive, so you don't want to have great exposure to the defensives in here, and you want to be cyclically exposed, but you want to keep tech in here because it's a mix of growth and value. It's what investors have been showing us what they want: broader diversification as we move towards a economic recovery stateside and likely sustainable economic expansion next year.
Ryan, John makes an interesting point. If you look at the sectors that have been growing their earnings per share this quarter, it's the industrials, which are up 33% year to date, and technology. Do you stick with these sectors, or because of the geopolitical situation overseas, is it time to get more defensive?
I think I actually get a bit more offensive here on the international side as well. So, no, I actually agree with John here. I think cyclicals are a good place to be. But also this year, I mean, you'd be surprised to know the French stock market's actually outperforming the NASDAQ right now. So I think if you're going to allocate capital here, not only do you want to own U.S. companies, I think, John, you're right, continue to own tech in here, but also own those cyclical stocks. But I also would look overseas as well. Valuations are a lot cheaper. And we know, France is not the hotbed of technology. But, if you look at old school cyclical companies, that's a lot of what Europe is. And you start looking at valuations overseas, they're much cheaper than the U.S. And Europe's on fire right now. And it's almost like been a curse word to own Europe in your portfolio the last decade. But I think right now and moving forward, it's a great place to own, allocate capital in your portfolio.
John, international, where would you put money to work, especially at a time where we are seeing this crisis unfolding in Afghanistan?
Well, we're overweight U.S. markets. We have meaningful exposure both to international developed markets as well as to emerging markets, with a preference for the developed international markets first off. But we think the relative strength of the dollar has made it tough when translating returns back into the U.S. currency for U.S. investors. So while we like the international markets, we want meaningful exposure because we think as the U.S. proves that its economic recovery will lead to a sustainable economic expansion, U.S. Consumers are going to buy a lot of imported goods. That's big stuff for Europe with all the luxury items, as well as consumer staples, materials, energy, et cetera, which should be good for that as well. But John, we remain overweight U.S.
Just addressing the situation in Afghanistan, I mean, do you think this becomes a bigger risk for emerging markets, the neighboring countries around it?
At this point, it's really a situation to monitor. We have escalation in terms of geopolitical risk and political risk. The risk at home is how Congress decides to spend its money. We're hoping it doesn't overstimulate the economy and lead to stickier inflation.